But now let's say that because of the criteria of textbooks, you decided to buy the spread. Or let's say because of the criteria in the books, we decided to buy a different spread. Let's take a look at buying a different spread. Instead of the one we were just looking at, let's say we're going to go out and buy the 305, 290, 265 spread. Again, the difference between 305 and 290 is $15, and the difference between 290 and 265 is $25. It's still a 15 by 25 broken wing butterfly, but now we can put it on for a 40-cent credit. A little bit better than a 10-cent credit. How much room of protection do you have on this trade is the first question that many of you are going to be thinking of or wanting to ask me. And it should be the first question that you ask yourself when you put on this trade. How much room of protection do I have? Where do I have to start worrying about this trade? I know that there is a $10 risk in there somewhere. I know that it happens almost always at expiration that it becomes a real risk. And sometimes, depending on volatility and other things, you know, you have to start worrying about it a little bit before expiration. That's all explained in our textbooks. But what if I put on this trade right now? How much risk do I have? And the answer can be seen real simple by looking at the option chain. The reason I showed you how to determine what an option works or how to price an option after it moves through a strike is because it works the same way for spreads. If one option will move from one strike to the next strike in price, say $21 to $24 because the market moved in your direction, a spread works the same way. So we can take a look through the option chain and see how the broken wing butterfly will work as we move through the chain, just like we can with one option. We can do it with all three strikes instead of just one strike in the same way. And this column over here, this third column I told you to ignore for a little bit, we're going to address right now. This is the spread column where each one of these numbers in the spread column represents a broken wing butterfly that is $15 apart by $25 apart. Okay, we looked at the 330, 315, 290, the 330, 315, 290 spread, and we saw that was trading for a 10-cent credit. Okay, now we're looking at the 305, 290, and we don't see the 265 options because I didn't want this option chain to get ridiculously long because then you wouldn't be able to read any of the numbers, but the 265 strike is down there. And we see that the spread is now trading for a 40-cent credit. Where can this thing move to before we start losing money? Well, we know that the risk to this butterfly and the profit to this butterfly are both on the downside. So where we would run into trouble is if the market went down. If the market went up, the broken wing butterfly would expire worthless, and we keep our 40 cents. So we don't even have to worry about the upside. If the market goes up, it goes up. And then that's why we teach in some of our classes how to use these broken wing butterflies actually as a hedge to portfolios, where you can use them to hedge a portfolio of stocks, actually, instead of having to go out and buy a whole bunch of puts that are going to cost you a whole bunch of money, and then they expire worthless. So what you see here is this put that we bought, or this spread we bought for a 40-cent debit. We can trace it up the strikes and down the strikes to see where it would go if the market moved in the same way we did with one single option. And what we're going to do is we're going to start getting concerned when the spread we bought for a 40-cent credit starts losing money. Now, again, when we're going through the strikes, remember, as the market goes down, we're getting closer to at the money. So this 305 spread, if the market goes down, we'll be getting closer to at the money, which is higher up, above us. So we will be moving up strikes to get closer to at the money. If the market moves down, we don't have to worry about it because, up, we don't have to worry about because we'll be going down strikes. It'll get away from the money and it'll just expire worthless and we'll keep our 40 cents. So here we go, guys, and we look and we see that the spread we bought for 40 cents, if the market moves down one strike, the spread is going to go to a 20-cent credit. Well, we bought it for a 40-cent credit, and now it's at a 20-cent credit. So we're actually up 20 cents. Now, if the market moves down two strikes, the spread goes to a 50-cent credit. That's not really that big of a deal. Here we will be down 10 cents. Okay, the market moved $10 or two strikes, and we're down 10 cents. But we'll see that we shouldn't really concern ourselves that much because if the market moves down again, another strike, a third strike down, the spread goes to 10 cents. So the spread we bought for 40 cents is now trading for 10 cents. We're up 30 cents. Now it's going for a 10-cent debit. So we'd be up 50 cents. One more strike goes back to 10 cents. Another strike goes to 20 cents. And then at the 340 strike, it goes to $1. So what does that mean? Simply move up the strikes until the spread increases above what you paid for the trade. And that's where your real risk starts. We did see a 315 strike that it went above our price. It went from 40 to 50 cents, but it only went up a dime. And as a matter of fact, at the next strike up, it went and became profitable again. So that's not really a big concern of us. But what we do see is at the 340 strike, the spread goes to $1, and the next strike higher is 210, then 310, then 250, and then 190, and 240, and 260, and so on. And so we don't get the reverberation where it goes back down to a profit area again if it moves another strike. In other words, in this example, where there are 40 days left until expiration, we don't start losing money until the 340 strike. What does that mean? It means we have $35 of risk. We have $35 where the market can move in the direction of our risk, which is 7 strikes of protection before a loss occurs. Now, just think about what that means. $35 on this index when it's trading at 325 is almost 11% of the market value of the index. In other words, the market has to fall by 11% before we start losing money. And how much money did we lose? The spread went from 40 cents to $1. We lost 60 cents. It's still less risk than had we bought the butterfly on the puts and the market immediately zoomed up and we decided to stay in it because, it just, maybe it'll come back down and then the spread expires worthless and we lose 70 cents. So here, even though the market moved 7 strikes, 11%, we only lose 60 cents. So where would we get out of this trade at random walk? Well, why wait until it gets to where the spread looks like it at the 340 strike? Around 335 strike, we know it's time to get out because the next strike we're going to start losing money. And that's the great thing, guys. That's the powerful thing about these trades.